everyone. Welcome to Refinitiv ESG event. This is Péter Hidvégi. I'm the operative manager for Refinitiv Hungary. I would like to welcome you all again. This event is particularly, besides focusing on ESG, we want to concentrate on your investment decisions. And as an introduction to the speakers itself, I would like to first mention Ács Barnabás, who is our Global Director for Sustainable Finance, and second but not last, Kevin Pollard, who is our Senior Research Analyst at the company. They will present to you. It can be interactive. Please use the Q&A box in the bottom right section of the screen to insert your questions. The session will be recorded, which will be shared with you later on, along with presentations as well. This is all from my side. Once again, thank you very much for joining, and the floor is over to you, Barney. Thanks very much.
Thank you very much, Peter. Good afternoon, everybody. It's a pleasure to be here. We have a very good audience. I think we are north of around 10 people, so good in size, and but still small enough to ask questions. And I have to say we would very much looking forward to that in this session. So please. Challenge what you see. Ask any clarificatory questions in the Q&A section, and we will look to get back to you. We understand that when we discuss ESG, either from a company angle or from fund angle, the Central European region, being a smaller market, and specifically Hungary, is a little bit different than it is in the mainstream developed market, or not. I wouldn't maybe use the word developed markets, but with high capitalization markets, where obviously coverage is better on company level, and obviously that has an effect for funds as well. But nevertheless, we have different solutions as well, which could enable data reporting and data coverage increase, even the smaller markets as well. So if you have that kind of affinity and aspiration, we are more than happy to discuss those angles too. So when preparing for this session, what we try to sort of think about is how can we make this relevant to you, and when what we are going to discuss is basically sustainable finance in 2021. We don't want to really spend too much time on it. It's just every slide deck has to have a beginning, so to say. I appreciate that everybody of you who joined will have an ESG angle already. The ESG data collection and rating is, of course, an important topic, an important input into funds, and it really addresses a couple of regulatory readinesses as well. So I'm trying to address these questions from that angle and from that relevance. And of course, discussing a little bit the EU Sustainable Finance Regulation, the SFDR, which is applicable to asset managers and wealth managers, and basically to the wider financial market. Then my colleague, Kevin Pollard, has accepted the invitation, and he's going to talk about the Refinitiv Lipper Fund ESG score, how the company scores are rolling up into fund level, what are the peculiarities, and what are the challenges and the way forwards as such. So, it's just that slide that I was discussing, that albeit the ESG market is still relatively small, it's increasing, albeit the COVID last year, it's pretty remarkable. So it was nearly $500 billion USD that flew into ESG funds, and to highlight that these are funds that specifically classify themselves as ESG funds. It doesn't take into consideration any overlays as such. The other angle, the other side of the slide is the sustainable bonds and loans. The issuance of sustainable finance bonds totaled nearly 550 billion USD during the year of 2020. Again, a new high compared to 2019. We saw all kind of commitments and forecasts that basically are indicating that ESG is going to be the mainstream factor when it comes to financial analysis of companies and when it comes to portfolio building. We have seen a couple of regulations coming up. That's also a topic of this presentation. The megatrends for the next decade are revolving around digitalization, regulation, infrastructure, and of course wrapped around is sustainability as well. We can't really evade two very significant facts that climate change can be explicitly felt by general public, and as such, it has to be administered and handled by the different governments at the highest levels. You are seeing here a couple of commitments that have actually made 2020 a little bit more committing to the climate change, and adding to that to the just recovery coming from the COVID-19 pandemic and its economic effects. So when we look at 2021, what's important to highlight is the COP26, which is going to happen in Glasgow, and basically that's the conference of the parties, which is having the 5 years anniversary after the Paris Agreement was signed, and as such, there is a huge kind of looking back and current situation analysis and what has to be done. You might have heard and followed news about 2 days global conference around Earth Day last week, and the commitments around that are really indicating that the countries on government levels and on the highest levels are really keen to put actions behind their words. You also see America's role very much increasing in that space, and the fact that the Biden administration is living up to the promises that were made during the elections. You also see more mandatory disclosures coming to markets. February was about the latest list of the regulatory technical standards on the sustainable finance regulation, disclosure regulation. You saw 21st of April when basically NFRD, the non-financial reporting directive, was launched again in the form of the corporate sustainability reporting directive, which is now clearly aiming to increase disclosure in the ESG space, and it also broadens the scope for reporting companies. You might have heard about the higher and higher, penetration of hydrogen and green hydrogen as a new technology that could sort of play a pivotal role in the transition to a less emitting infrastructure and economy. It's interesting to see that in this area, last year there were 21 projects announced in the green hydrogen infrastructure space. In the last 10 years altogether, there were 3. So that kind of initial boost in momentum is showing that this is going to be a technology that is going to be providing scale to hydrogen production and transportation, and would make hydrogen as a commodity of basically the current decade. And obviously, with all these, data for sustainability 2.0 is kickstarting, collecting as many information about as many companies about as easily and scalable as possible is the sort of the new challenge and the new set of solutions that is coming to the market. So with that kind of relevance, what I would discuss a little bit is how an ESG rating is built up. Obviously, it's going to be through the lens of Refinitiv and London Stock Exchange Group, but I will try to make this as informative as possible and cut the salesy angle of it as possible. By all means, open to any questions you may have. ESG rating, as such, if we think about it, is basically a pyramid. At the top of it's normally at the top of the pyramid itself. It's an aggregation of different underlying informations, and it's actually quite important to know what kind of underlying information is used in order to be able to make a proper judgment call. Hence why it's very important that the pyramid that you are looking at is a sort of a Louvre-like pyramid, i.e. it's a glass pyramid, and it enables see-through to the details. In our case, specifically, we collect 450 ESG-related data points about the company, from the social, from the environmental, and from the governance angles, comprehensively and quite evenly distributed across these three main angles. We have built-in disclosure stimulus into our methodology, which actually incentivizes companies who have the data available. They just not to disclose those data sets, because the more they disclose, the better the rating could be, especially in material factors. Of course, materiality is a very often used buzzword, both in financial analysis and both in of course in ESG terms, and there is this term of double materiality as well. It is actually quite difficult to capture. So when it comes to materiality, there needs to be transparency about how that materiality was derived and what kind of weight is given to each angles of materiality. I will discuss that in a second. And of course, everything that you see in a rating has to be derived through simple formulae with as little black box as possible, so that the rating mechanism itself can be checked quickly, can be audited quickly, and that it can also provide a sort of an ideation for personalized ratings. I understand that at least some of you who have joined the call would have their own kind of in-house proprietary ESG rating, working with multiple resources and with multiple formulas and angles that are not necessarily the same as the mainstream ones. When we sort of look into the pyramid itself, we will see that it's broken down into several angles. It's important to highlight that ESG data as such are generated through CSR reports, which unfortunately are also sort of PR reports as well, heavily textual documents, and trying to service the company's PR and marketing efforts as well. So hence why it's very important that there is a sort of a check and balances system built into the whole rating mechanism, carved out, but still included within the whole rating is the controversies. This is basically negative news about companies and companies' operations, and basically indicating when the company is not living up to this sort of the self-reported and self-created expectations. Then when it comes to the company-reported angle, which is described by the ESG score, that of course has the three legs of environmental pillars, like environmental, social, and governance, which is broken down into individual categories within those pillars. It is resource use, emissions, and product innovation in the environmental pillar. It is dealing with workforce, human rights, community, and product responsibility in the social pillar. And it scrutinizes management of companies, shareholders' rights, and CSR strategy in the governance pillar. All these categories are rated, and there is a combination of 186 metrics that are sort of determining either of these categories. So basically, another sort of 250, 300 metrics are also available beyond the rating itself to scrutinize a company's performance from an ESG perspective. I have to say that, you know, the more this information is integrated into the financial analysis, the better yield it would bring, and the more effective it would be. This is basically just a view to be able to sort of put a imagination to it on how it looks like. So this is all built into the company information profile. As you see in the tabs, it is also showing different estimations, financial data, ownership structures, and events about the company, and ESG is inherent part of that. You, in the middle of the screen on the left-hand side, you'd see the different ratings for overall rating, for the controversies, and for the different pillars. You see that having a controversial set of operations will drag down the well-reported numbers quite severely, and this is a near quite real-time compared to the annual flow of ESG reported data. Whenever you see a blue in that screen, that's immediately audible. Immediately audible information, which is basically leading the user to the underlying information in the public document. So when it comes to scrutinization, I just thought that I bring a topic to you. Obviously, we have raised the climate-related metrics as focus of attention. You see in this screen that we are covering nearly 30 metrics about a company's climate-related activities, and these can be ranging from, you know, having emissions policies and emission targets to scope 1, scope 2, scope 3 emissions, total emissions to revenues, and of course questions around internal policies such as when is the reduction target year, what is the reduction target percentage, if there is any internal carbon pricing going on, and what is the price of that internal carbon, what is the internal price of the carbon. You know, this is a TCFD metric you might have heard about, that based on the commitments that have been raised last week, I wouldn't say it's a company we, but I would say that that internal carbon pricing will play a crucial role even still this year. You also see that these metrics play different weights, or have different weights in the final rating itself. On the right hand side, what you can see is basically the emission categories weight as per its materiality. So on the top section, you see coal. Within that industry group, every company that is analyzed has a 20% weight associated to emissions. Whereas in the banking services, you see that number being 2%. That, going back to the disclosure incentive, it's very important to understand that if a company where, you know, emissions is important is under-reporting, their kind of rating is way more severely impacted than in the cases where the maturity is not that significant, like in the banking space. Just a couple of words on sorry, I'm playing around with this presentation mode here. So a couple of words on the database. So how to imagine that. Again, this is basically for the top level and the utmost left-hand side only. It shows that we have a very detailed data base of record where you know, we do everything to fill that in as much as possible. When it comes to ratings and ESG data, it's important to understand that we cover around 80% of the publicly listed global market cap. We do cover around 25 indices that we constantly maintain as per constituents changes. We have heavy coverage in North America and Europe, and we have nearly 1/3 of our coverage also coming from the APAC MEA regions. We have been acquired. Refinitiv was acquired by London Stock Exchange Group in the beginning of the year, who also have a distinctive ESG data set, who have very good strengths in the Far East, including Japan and China. When it comes to rolling up these ratings and also analyzing company credit, you know, we use the company ratings to determine company issuances, and we also have a very robust methodology, which Kevin will talk about, to basically ESG analyze funds. We have around 29 trillion assets under management right now that bear an ESG score. I think I can skip the data collection because I talked about it. Just one word on sustainable finance disclosure regulation. The articles that are very important in them. So basically this regulation, just very shortly, because I'm certain I'm speaking to the converted, it basically aims at financial market participants and tries to create transparency in how ESG angles of or considerations of portfolios are met. And there are 3 categories for this. It's defined by Article 6, 8, and 9, which basically Article 6 says that everything has to be discussed from an ESG angle, and basically if ESG is not taken into consideration, it has to be explained why that's the case. Then Article 8 is discussing portfolios where ESG is taken into consideration, and Article 9 being the sort of the strongest, or the quite a blurred line between Article 8 and 9, are related to information disclosure on funds or financial products that have the objective of sustainable investments. Now, in order to sort of make clarity around how to demonstrate Article 6, 8, and 9, the regulation added a sort of a regulatory technical standard document to it, which is describing the list of metrics called PAIs, or Principal Adverse Impacts metrics, that are of course listed in different angles of ESG, and every portfolio manager or portfolio reporter will have to report on these metrics come 2022. When we are talking about the left-hand side here, about the PAI, or the Principal Adverse Impacts, we have to appreciate that actually there are 3 tables of Principal Adverse Impacts. One is this sort of the mandatory table, and what is actually quite new is that it's not related only to companies, but it also relates to sovereigns and real estates. The other 2 tables, albeit optional, they require the reporter, i.e. the let's call the financial market participant, to report at least or disclose at least one metric from each table. Table 2 is heavily focusing on climate and other environmental related indicators, and Table 3 is very much social and employee heavy. We currently have 58 metrics out of the 64 that we either directly or indirectly cover, and of course once the list of metrics is finalized, hopefully by mid-May, we will start the collection of the missing 8 metrics as well. What we are going to do is basically providing 2 types of solutions. One solution is aiming at providing a sort of a ready-made analysis of portfolios, which can be seen on the right-hand side, basically aggregating the portfolio level the principal adverse impacts that are aggregated based on the constituents of the portfolio. And the other one is basically a sort of a feed solution that enables customers who don't want to share portfolio information with a third party to calculate their own aggregation using the provided necessary underlying data sets to it. Just a quick show of PEI metrics. On the left-hand side of this, again, this slide deck will be shared with you, and we, for any follow-up, we are happy to provide the Excel template as well. You see basically the first 3 columns of this Excel with the darker heading are the ones that were listed by the European Commission or ESMA, and the bluish or the blue-headed columns are basically the matches and the measure descriptions, the codes which can be found in different Refinitiv applications, and of course the calculation formulae for those aggregations. So with that, I think I'm coming to an end of my side of the presentation. I will hand over to Kevin, and of course I will have a look at the Q&A as well. But Kevin, please go ahead. You are on mute, Kevin.
Thank you. I'm Kevin Pollard. I'm a senior research analyst at Lipper. I've worked here for 20 years. Started as a portfolio data analyst, and now I'm on the research team and more heavily involved with the ESG side of the business more recently. In fact, Lipper has been doing, fund classifications for years, but only from last year did we onboard ESG scores as a roll-up of Refinitiv company scores. So let's see where we are now with that, if you like. We have, at the moment, where we started off with nothing from June 2020, and then we launched something like 20,000 portfolios. And I think we're up to 30,000 portfolios now on our database, which represents 29 trillion USD in total assets under management across, where it says across equities, bonds and mixed asset funds. But essentially, if we have the necessary Refinitiv company scores data for a portfolio, then we will give it a rating, which you see here highlighted in an example in icon with the scores of the portfolio and the history of the portfolio of scores for all those data points, which I'll come on to in a minute. The data points at a fund level, it's not just one ESG score. Barney talked about a pyramid, where at the highest level we've got the ESG score and the ESG combined score, which combines the ESG score and the ESG controversies, the bad news stories, if you like. So Lipper have rolled up all 3 of the high level. We've also rolled up the 3 pillars, environmental, social and governance, and all of the 10 categories beneath that. So for environmental, you have resource use, emissions and innovation categories. Lipper will have a rolled up score for all those 16 data points. So 10 categories, 3 pillars, and 3 overall scores. And we do it in exactly the same way, which I'm about to describe. First of all, we start with the portfolio of assets. So we have, obviously, maybe, you know, if there's any portfolio managers out there, you'll know maybe you have 5 share classes, but only one portfolio is looked at with a series of assets that might invest in equities, bonds, property, whatever, really. And the first thing we do, because portfolios might contain other portfolios or funds, we look through to the underlying security detail, and then we access Refinitiv company scores and pull in all of the relevant data. And then before we actually assign a score to the portfolio and roll it up, there are some eligibility tests that we undertake. You know, we make sure that data is of sufficient quality to get a LIPA ESG score. And the main test really there is that we ensure that the portfolio has 70% of its assets by assets under management, TNA, total net assets, scored with a Refinitiv company score. So the majority is scored. We need to have a minimum of 10 securities in the portfolio with a score. And we also check the calculated Refinitiv market value against the TNA, the total net assets that the asset manager has provided us with as an extra check to make sure that we're calculating the right the weights for each of the security. Once that's all checked and onboarded, we move on to the next stage, which is, you know, say if you've got any cash in your portfolio, it might represent 20%, and the other 80% is scored. We'll then rebase the 80% to 100%, and we'll then calculate the final weighted average score, which of course is just weight, at the market value in the security, divided by its TNA, it was the total securities that have an ESG score, and multiplied by its ESG score. And then you sum up all those, and you, hey presto, you have 16 fund level scores, which are accessible through LIPA Global data feeds. There's a specific ESG scores flat feed with all of the 31,000 portfolios, or all of the history of the scoring that we've done. By the way, the history there goes back to May 2019. We drew a level marker in the sand, if you will, for the start date. ESG scores on portfolios, because of course before that ESG data was rather sparse, so we didn't see any value in calculating way back to, you know, the days where we hardly had any ESG data. And of course over time we'll be able to look at one portfolio and see that the progression of the ESG score of that particular portfolio, dependent on its availability in LIPA, of course, but we do have a very good portfolio coverage in general. Those are governed by strict disclosure rules as well. So if a company doesn't want to disclose their portfolio at all, it won't get an ESG score. But by and large, we do have some very good relationships with fund management companies to give us the coverage that we've got. And of course, because it's a pyramid, over time, as the ESG data increases at a company level, then so will the 70% necessary ESG check be passed, and more portfolios will come into the LIPA suite to get ESG scores. So those are the 16 scores there, which on the flat feed we would then combine with LIPA global classifications for the portfolio, US mutual fund classifications if you were a US client, and then coverage checks, you know, is it 70%, is it 80%, is it 90%, and how many securities in the portfolio. And we'd also give you a holdings-based classification cap and style, simply because of the nature of ESG scores. I think, as Barney has explained, the score itself is a kind of best in class per industry sector. So because it's judged on industry sector and portfolios invest across industry sectors, I guess what you have to realise is that the rolled up score is a mix of those industry sectors, and as such it represents a best in class ESG score for the portfolio as a whole. So the thing to watch really when comparing LIPA ESG scores is the type. We have to use the classifications of the fund, otherwise we may be comparing apples with pears. What do I mean by that? Well, larger companies report more than smaller companies at the moment. Obviously, we do expect that data to increase and equalise, but to some extent that will always be the case. In case of style, there is some phenomenon where value-oriented companies will report more than growth companies. So straight away, LIPA has those capabilities to look at holdings-based cap and style and to kind of equalise the peer groups such that then the ESG scores will become relevant in that particular sector. And I think next slide is just showing you product views, really, of those scores and how they might break down the high-level scores, but we have more detailed views available as well. And next, I want to say a little bit about the attributes that LIPA have plans for in 2021. At the end of 2021, we're hoping to release certain attributes key to ESG and also key to making meaning, better meaning of the scores that we've got available, so that we can again compare like for like, which is what LIPA is all about. So what are they? Well, at the moment, LIPA has one flag called it an ethical flag. And the meaning, it's been on LIPA for a long, long time. And it encompassed a broad range of non-financially motivated objectives. So if you look at the ethical flagged universe on LIPA at the moment, you'll see a whole range of funds, not necessarily comparable with each other in the modern day, but all indicating that the fund has some objective which is not exactly financial. We're actually engaging on a collection at the moment to improve that and replace it with a responsible investments attribute, which will be much more granular. So the data analysts are collecting at the moment and populating these yellow boxes, if you will. So for example, here on ESG, the data analysts will be looking at the public literature, not the portfolios, but things like prospectus, fund name, objective, key information documents, anything that's in the public domain to indicate the objective, and looking for the language of ESG or SRI, or indeed negative screening, positive screening strategies, including thematic funds like alternative energy, best in class, which are obviously sort of benchmark focused, if you like. ESG strategies can be better than the benchmark or the peer group. And then obviously the more modern growth that Barney's already talked about in sustainable bonds and green bonds, we're going to flag those strategies too. And each time that this micro category is flagged, then LIPA will roll that up to the next level here. So any of these three flags, if ticked, will lead to an impact investing attribute, which will also lead to an RI attribute. So the user of our data will either be able to look at responsible investments overall or be able to go drill right down into the details. And that's going to become quite important to differentiate between particularly the new style funds that are using ESG data, such as the as the data that we provide and analytics to basically manage ESG as a risk to financial improvement, versus those funds that are kind of investing for the good, if you like. So more socially responsible funds, funds that avoid sin stocks, if you like, and funds that are injecting capital into green themes and social themes. So that those are two very different beasts, and you might want to look at the performance of those very differently. And finally, a little piece about the regulation, the SFDR that Barney has already explained, but at LIPA and the funds arena in Europe, that European regulation plus the UK version, if you like, is intended to be collected in regulatory documents, the MiFID templates, and a new EET template, which is to capture ESG and sustainable data from a regulatory perspective. Now, we don't want to wait for that, so what we're trying to do is wrap in the basic SFDR allocations to Article 6, Article 8 and Article 9 in with the Responsible Investing Attributes Initiative. Now, I think the main difference really is that this attributes assignment here will be done as a LIPA independent assessment of the public documents. So that's very different from engaging with the fund company and ask them to tick these boxes, because we want to be avoiding greenwashing. And it's important to state that along with this initiative, we will have a responsible investment start date, so that obviously when a fund engages a new strategy like ESG or sustainable bonds, there's a start date to that, and that's to make sure that the whole performance history of a fund or the whole flows history or the net sales history of a fund isn't greenwashed. So you can imagine a fund that's been around 30 years but may have merged with another group that's been running an ESG strategy. We don't then want to sort of tick that as a green strategy that's been running the past 30 years. So we're going to maintain some integrity there, and then we're going to look at the separate regulatory collection and see how the rules there might interact with the LIPA collection. So, for example, we'll be looking at quality controls that says if a fund discloses to us that they're Article 6, which is neither ESG characteristics or a sustainable strategy, then how can we have a responsible investment attribute? So we think it's important to onboard the regulatory stuff, which we already have 50% behind the scenes collection for the whole EU universe, if you like, to enable our clients to compare and contrast and again use the ESG scores in conjunction with LIPA classifications and in conjunction with LIPA responsible investment attributes to put meaning behind the scores and to build the peer groups that they're interested in. Hopefully on the Hungarian side as well, I will be discussing with our business managers how Hungarian portfolios can be enabled with ESG scores, which is something that we're getting very, very soon. That process is pretty much complete. And also from the BAMOS side, I'm hoping to renew engagement there with that particular fund association in your area so that some of this data can be more readily available, the classifications can be more readily available. So that is it from me. Anastasia, is there another speaker, or am I the last?
You are last, Kevin. If you could just go to the next slide. we just wanted to highlight that we run the Refinitiv Academy that is providing additional insights on climate-related analysis on company and portfolio level in ICON. And of course, there are other interesting topics. The next one that is coming up is on the 12th of May, and a lot of you might know, I think all of you know, Anita. She's going to lead that session. So please feel free to engage and sign up. Just as per questions, do we have any questions coming in? I mean, I encourage the audience to type in their questions. We don't see anything so far. I mean, we made good use of our time, but if we could add some interactivity to it, that would of course be a favorable outcome. Any questions to me or Kevin or the funds in general? If not, maybe Peter, I give a couple of words back to you if you.
Yeah, thank you, Barney. Thank you, Kevin, for the presentations. As mentioned before, we will share the live recording of this session and the presentations after the event, and we welcome you all to join Anita's workshop, which is taking place next, as Barney has mentioned. And if no questions at all, actually I just see that there is one question.
Kevin, it's rather to you. The eligibility test mentioned, is this manual or automated?
I think so, yes. So I think that refers to the 70% of ESG scored securities required to get a portfolio scored, and that is an automated process.
Thank you.
Thank you, Kevin. Well, if no more questions, then we are giving you back over 10 minutes. And once again, thank you all for joining. And if you don't mind, then please fill in the questionnaire. We would be happy for your valuable feedback. Thank you very much for joining once again. Have a nice rest of the day.
Thank you.
Bye-bye.
Goodbye.